So tell us, Mary Ann, does any of this remind you of 2007, 2008?
Absolutely not. And I think this is the key message that we're sending out to our clients, is that this is a very different environment. You had a lot of leverage in the 2000 period and in 08-09, whether it was market leverage. In 08-09, the consumer was levered, the government was levered, the banks were levered. We've really delevered the whole system. Really what we're looking at is a repricing of markets. So the biggest concern is global growth. So we're trying to figure out where is global growth. China has been the big concern. You're seeing the sell-off in the commodity space. You're seeing earnings last year actually turn negative. We're calling it an earnings recession. Top line growth, revenue growth has been slowing. And you had the Fed raise rates. So it's very natural for the market to reprice the price earnings ratio, or what we call the PE ratio.
Okay.
So we are finding value. It's where you want to be within the marketplace. We want to be in very large cap, high quality companies and reduce our exposure to small caps. So quality is even the key in fixed income. We're seeing credit spreads in high yield expand. We don't want to be there. We want to reduce, and we want to be in very high quality bonds.
So where are we in the repricing, though?
Well, here's the thing. If you look at the average stock within the market, it's already off 25%. Right? Small caps are already off 20%. Transports are already off 20%. So it's some of the larger cap stocks that have held up the market averages. So the market here is going to try to hold around 1850, 1820.
Okay.
If that does not happen, the next support within the marketplace is around 1600. So the risk is that you do get another 10%, that you're only halfway through.
We've got another leg lower here then.
That's the risk. That's the risk. But the question is, where are we in the cycle? We call this a cyclical bear market, not secular. We think we're in the early stages of a secular bull market, meaning the market is going to
early stages?
Early stages.
Early, okay.
We actually classify a secular bull market began in 2013, and that can last for 13 years. So if the market, should you see the market pull back to around that 1600 level, I think this is the best buying opportunity clients are getting since the lows of March of 09.
That's quite a big call.
Yes.
But Mary Ann, the markets were gaining even before 2013. So what did you call that?
Well, you're still in it was all a bull market. The term cyclical and secular has to do with the trading pattern.
Okay.
We broke above the highs of 2000 and 2007. So we're in a totally different period. It's not that sideways trading range anymore. We think the markets can trend higher over the coming years, and that there's great value now being priced within the markets.
So if I'm to read this correctly then, perhaps look out for another 10% correction or so, and then you're calling that the buy of the year.
The buy of a lifetime outside,
buy of a lifetime.
Outside of March of 09, because our long-term price objective on the S&P is 3,500. So over the next 10 years, we think there's significant more upside to the equity market than there is downside. So it's about really looking at the longer term. But we do think market volatility, and this is like episodic volatility, brief bouts of very violent volatility, are bringing about opportunities for clients to reposition portfolios. And that's how we want to look at it, because when we really value stocks versus bonds, stocks are just so much less or so cheaper compared to bonds.
Right.
And here's a very important statistic. Every time the S&P yield is above the 10-year Treasury yield, over time stocks go up. And right now, if you look at it, the
that's
S&P,
what's happening?
That's what's happening. So these are some of the key long-term signals that we're looking to buy the market.
Outside of technicals, Bill Gross was on earlier saying that, look, this stock market rout basically shows the failure of central bank policy. What do you say to that?
I wouldn't go that far. I think the market is really trying to reprice growth. China is really the big concern. We're seeing that economy slow from a 7% GDP somewhere between 5 and 6. You're seeing the rout hit commodities, materials, energy. And in terms of trying to price that into our markets, what we're trying to tell our clients is 70% of GDP growth comes from the consumer. And the consumer is doing very well. And this decline in oil always benefits the consumer. It's just about what they're doing with their excess cash. They're saving, they're paying down their debt, their balance sheet's the best that we've seen since the 1980s.
Or we may not have seen the effect yet, right? It takes a few quarters, doesn't it?
It takes a few, but they're being very selective. They're not doing retail, but they're eating out. and they're paying down their debt. And those are longer term positives for the market.
So Mary Ann, what do your charts say to you about where oil is headed next?
Well, everybody's been talking about the 20 to 25 handle, and you're almost there.
We're almost there.
We're
yes.
almost there. So you're in that range where eventually oil should begin to stabilize. But then the question is what happens after that? And typically after a rout of this magnitude, because you have to remember we were up over 100 and now we're starting to talk about 20, it's going to bounce along the bottom for a period of time.
Okay.
So we're not looking for it to rise rapidly, but over time we would expect crude to get back up into the mid 40 range.
Are we going to bounce because we need to work through all that supply? Is that why?
That is correct. I mean, the
Okay.
supply and demand imbalance is still there. So you'll eventually stabilize and you have to work off that supply.